Good morning, everyone. I'm Neha Agarwal, your host for the second episode of SageOne Manthan Series. Our Manthan series was launched in Jan 2024 with the endeavor to collaborate with relevant industry experts from within our team and outside across industries to bring forth deep dive conversations in subjects of common interest. In fact, in the first episode of Manthan, we discussed about the importance of succession and estate planning and geographical diversification with the multifamily office Mefezale from the team of Thermax Group for Family Office. Today, we are glad to present to you Stage 1 Manthan Series 2, where our investment team members Kshitij, Kaji, and Dushyant Mishra will do a deep dive discussion on the Indian retail sector. So, a quick introduction to our speakers. Kshitij, Kshitij Kazi has nearly a decade of experience in the equity research, both on the buy and sell side. He really enjoys identifying mega trends and focuses on softer qualitative aspects and behavioral finance. Uh, by qualification, Kshitij is a CFA charter holder as well as a Masters of Commerce from the Mumbai University. About Dushyant, Dushyant has been a member of our investment team since 2018. Has done his master's in mechanical engineering from Texas A&M and has also been a design engineer at Volvo, Eicher, and General Motors. With his expertise in bottoms-up research, Dushyant actually keeps a very keen eye on changing industry trends and looks to find opportunities in them. So over to you, Kshitij and Dushyant.
Yeah, good morning, everyone. Yeah, and thank you so much for your time today for this webinar. So, hopefully, over the next 1 hour or so, we would like to, take you through the whole Indian retail landscape, and we would like to keep it, very crisp and simple, and just point out basically the key drivers, that are running various subsegments in this space. So, how we've done it is that we've divided this presentation into three different parts. So, the first part will be touching upon what are these key drivers that are required to become a successful retailer, which could be anywhere in the world. The second segment will be taking a deep dive into various subsectors of the Indian retail industry, and the third part will be just touching upon what valuations these companies get today, and are they justified or no, and just a broad take on these valuations. So I think with that we can jump straight into the first segment itself. So what exactly makes a successful retail business? So there are 3 points that we've listed out here, and we feel that these 3 points are somewhere interrelated to each other as well. And if you achieve these three things, then it's going to take you a long way in being successful. So the first point is a distinct product value proposition. Here basically we are talking about having a product which is affordable, but yet it's also aspirational, and which a consumer can easily relate to, and they find a lot of value in. So if you can create a brand or create a setup wherein a customer can relate to your product and they find it affordable but aspirational, then that is achieving the first step. If you are able to achieve this first step, it's most likely that the second step should start following, which is generating a high revenue per square feet. So this is extremely key in retail, as we'll see, going forward in the next few slides, that operating leverage plays a key factor in retail, and that's driven primarily by high revenue per square feet. So if you get high revenue per square feet, it typically drives down to even a much stronger bottom line and a return on capital employed. And with that, of course, you have to maintain efficiency and keep a strong cost control, when you're doing it. And generally what happens is that when you're trying to do a high revenue per square feet, it means that you're selling more products. You will need to keep more inventory in your store, and when you're doing that, you will need to have a very strong supply chain. So that brings us to the third factor, which is having a very efficient vertically integrated supply chain. You're not really dependent on other sources, but can control the entire chain. So balancing the growth and balancing the inventory that you put in the store and having a supply chain is absolutely key. So if you achieve these steps one after the other, typically it's going to help you become a successful retail business. So as I mentioned, on the earlier slide, that retail is a very high operating leverage business. Through this slide and this illustration, which is actually of a company that's currently present in the Indian retail landscape, and these are the numbers that they were reporting some time back, and they are reporting today. So we've taken the numbers from there, and we just tried to showcase how it is a high operating leverage play, and what are the 2-3 most important things to see. So keeping a few things like the gross margin, the other costs, depreciation, the size of the store, etc., are the same. If we just tweak the revenue per square feet, say we increase the revenue per square feet of when we just compare store A and store B first. Here the revenue per square feet in store B is almost 25% higher than what store A is doing. But instead of just 33% higher, but instead of just a 33% jump in the store B revenue per square feet, if you just see the ROC at the bottom, it almost doubles. So this is key, and the critical thing to understand here is that most of the costs that you have are staying the same, no matter whether you're selling 15,000 rupees per square feet or you're selling 20,000 rupees per square feet. So as these costs are staying the same, your EBITDA margin improves from 10% to 17%. And if you are able to keep your working capital also similar to what your revenue growth is, which is say 16% of your revenues are what goes into your working capital, and if you keep it constant, then your ROC doubles with just a 33% increase. So this is, I think, key to understand. And we've also shown one more example where we compare just store B and store C, that where now you're assuming everything to be the same, even the revenue per square feet. But if you increase your working capital requirements, because generally what happens is that many retailers try to grow very fast, and for that they try to keep a lot more inventory in their store. So revenue growth doesn't come for them, but their inventory typically goes up a lot. So this dilutes your ROC, and over the short term, this ROC dilution looks very small. It looks like it's 66 to 48%. But when the inventory keeps piling up, you will need to start discounting at a much higher scale, and this will ultimately bring down your EBITDA margin and bring down your ROC further. So to sum up this entire slide, what we are saying is that revenue per square feet is absolutely the key pillar for you to drive a high ROC. But also it's equally important that when you're trying to drive this revenue per square feet, the inventory turnover that you're doing should be stable. It should be similar to your increase in revenues. It should not be materially higher, because that would lead to a future cascading effect, which would dilute our ROCs over the longer term. So if this model is very clear, then I would believe that the rest of the slide should be very easy for everyone to understand. Now in retail, typically what we've seen is that there are two different types of business models that companies follow. So one business model is where it's a very low volume but a high margin business model, which I think a lot of Indian retailers are currently following. So they focus more on the short term profitability and short term ROC, and making high margins in the short term. But what they don't realize is that when you are doing so and you are showing these higher margins and higher profitability, you are attracting more competitors to come in. So over the longer term, it may be possible that whatever business you're doing, and say more competitors come in, your margins and your return on capital employed and all these ratios may start reducing. And therefore Nick Sleep, who is a well-known investor in the UK, he had come up with this concept called scale economy shared, and where he cited that there are a few companies in the world in retail who follow this business model, wherein as they keep growing in scale, whatever benefits they get, they keep lowering these prices and they pass it on to their customers. As the prices are lowered, more and more customers want to come to them, obviously, because the prices are lower. And therefore, as more customers come, again the revenue increases, and again you get scale benefits. Again, these are passed on. So this becomes a vicious cycle, wherein you keep getting more and more customers. You keep reducing the prices, over long periods of time by passing on the benefits, and you keep growing, on an absolute basis. But however, this business model, requires you to think long term, because as you're keeping the prices very low from day one, it may be that when your company is smaller in size, you may not be making adequate profits or adequate return on capital employed. But over a long period of time, because you start making more profits and more ROCs, and because your costs are so low, it's very difficult for any new competitor to come in, and this creates an extremely long-term moat for these kind of companies. And hence there are very few companies that focus on this, but this long-term moat helps them maintain these long-term return on capital employed as well. And therefore these companies are able to scale up and become much bigger companies. Just one thing to remember here is that when it's much easier said than done, because as you keep scaling up, definitely you will keep adding more and more corporate overheads, and that is where these companies have to be extremely efficient in ensuring that that doesn't happen. And also, typically a low margin business is not a low profitability or a worse business. So that is something we need to keep in mind and see how the company is thinking in the long term. And typically these type of companies that you focus on long term, they do well even in a period of recession and in a period of when everything is good, because their prices are the lowest. So here, we just wanted to discuss two examples on, companies that follow this scale economy shared model, which I'm sure all of you must have heard of, Walmart and Costco. So they are two absolute giants, in US, which do grocery and other forms of, retailing. They both, have existed over different periods of time. So Walmart was present more from, the 1970s to the, 1990s. They showed very high growth. And I think when Costco came, around the 1990s period, and they've been there till today and growing well even today. Both of these companies, have had slightly different business models. So if you just see, Walmart's case, what they believe is that they want to keep, multiple products, but because of their scale, they keep these products at the lowest possible prices that are available in the market. Therefore, they have almost 1 lakh SKUs. Now, SKU means a stock keeping unit, which is each individual unit that you keep of a different product. So Walmart has almost 1 lakh different products that they keep, throughout all their stores. And because they have such a large scale, they are able to keep the prices the lowest. Now, what Costco does is that they only focus on certain units which are selling the most. So through their data mining over all these years and the understanding of the retail business, they figure out that in what region what product sells. So they have a membership which you need to sign up for, and you get special benefits from. And they keep their SKUs which only which customers want, and they sell it also in bulk. So typically a Walmart will sell, a single individual Coke can, but a Costco will sell you a pack of 6 or a pack of 12, and you have to buy it as a pack. But because of buying it up as at a pack, they're able to keep the prices lower themselves. So it's focused on few SKUs, but because those SKUs sell out a lot, again, you're able to buy those particular SKUs at a large scale and keep them at a discount. Now, in terms of supply chain, again, both of them are different. Because Walmart needs to have single units, as I said, they sell single Coke cans. When they get this entire material from the supplier, which is say Coke, they will need to unpackage it and then send put one Coke can in each particular store. So they need a very extensive logistics model. Well, in the case of Costco, because you're keeping it directly as a pack of 12 or 6, you get the package straight from the supplier, which is Coke, and you straight put the same package in your store. So you don't need to unpack it, then again repackage into a smaller batch size, and again send it to another store, etc. The material comes to your warehouse. Your store is only the warehouse. Customers come in and they buy it in bulk. So this is the model that Costco follows. And because Costco sells in bulk and sells these large volumes, typically the customers that come are more of the affluent kind who have more storage at home. While in the case of Walmart, more middle class growers go. So they both found their niche, but they both believe in passing on the scale benefits that they keep getting, and that's what helped them both to scrape grow over all these years, which is evident from their revenues and market cap, which are humongous in size. So they both do. So Walmart does almost $650 billion in revenues. Costco does $250 billion in revenues, and even the market caps are quite high. But the good thing to note is that they both have maintained their ROC over all these years after existing, and they both are 20% plus. Uh, even today. But these numbers would have been much higher had it not been for the threat of e-commerce. So one has to be aware of what new segments are coming up, and e-commerce has been one of them that has hurt these grocery retail guys. E-commerce's main selling point has been convenience, and the share of e-commerce from 5% has gone to almost 20% today. And Amazon, as we all know, is the biggest player here with almost $370 billion in retail revenues and a market cap of $2 trillion, but most of which comes from half of which comes from the retail segment. Now, one thing to note here is that Walmart also has tried to go into e-commerce, in order to adapt and evolve. but they've not done some great acquisition. So they acquired Flipkart in India, but that has still been loss making. But Costco has still decided to stick to doing what they know best, and therefore their PE and the ROC of Costco, as you see, in the bottom slide, is much higher than that of Walmart, because they're able to grow while sticking to their core business strengths. But Walmart is still, because of their size and scale, trying to go into different segments. So I think before we move on to the next slide, we would like to have two polls, just to make this a little interactive and see what you guys think of these particular two questions. So I think we can go for the two polls now. So yeah, this is the first poll. So basically the question is, H&M has continued its global expansion with a strong presence in India, and I think we all also have visited these Indian stores. So if Zara has delivered a 3 times market cap return over the last 15 years, what do you think would be H&M's market cap returns over the last 15 years? So you can mark the answer that you think would be correct. So we can now answer the second poll question. Yeah, so this question basically is that Shein is a Chinese e-commerce brand which has actually no store or physical presence in the world. So if Zara does $22 billion in revenues, what percentage of Zara's size do you think Shein is with just a 16-year presence in this segment? Sure. So I think your answers are in. We'll dive into the next step, which talks about all these things, and then we can also share the answers with you all. So yes, so the next slide is the need to adapt and evolve, and this is key. As we spoke of, Walmart is trying to go into e-commerce, but they've not been able to figure it out yet. This is a slide wherein if you don't adapt and evolve, it's going to be difficult for you to keep doing well. And here we mentioned the examples of Zara and H&M. So again, for I think consumers, both of these come across as very similar brands that we all go to stores and we shop from and we all enjoy. But actually, they both are very different. They have subtle differences which a consumer may not see, but they do their business very differently, and that's translated to the numbers as well. So Zara typically has a fast fashion approach, and what that means is that you copy the latest fashion trends. You make very small batch sizes of those products, and you have them put in the stores within just 2 weeks. And customers basically keep getting new stock every 2 weeks. So they feel like keeping on going back to these stores and shopping from them, because every time you go, there's going to be something new that you're going to find. And they want to give their customers value. They're not focused on giving you the best price, but they want to give you the latest fashion trends at the best price that they can do. And because there's no marketing or discounting, but because the products keep changing, there is a pull which is created automatically, and you keep wanting to go back to a Zara store. But if you compare this to an H&M, they operate very differently. For them, price is the key driver, so they want to price their products lowest, and they don't follow fast fashion, but they just believe in seeing what the latest trends are. They're making large batch sizes of those, and they generally take 3 months for those products to come into the store. So by the time the product comes into the store, maybe that fashion could be out of trend, but it's still catering to your basic clothing needs, so you're likely to go and buy it from there. But this is more of a push based marketing, that you're trying to keep the cost low, you're trying to, have more discounting, etc. And that is what is attracting the customer, and not the latest fashion per se. So because of these two different models, we can see that Zara's revenue per square feet has gone up by almost 50% over the last 15 years, while H&M has fallen by 10%. If you also see the inventory turnover, Zara is flat at 5 times, but H&M has fallen. And as we combine both these, as we had mentioned in our earlier slides as well, that these two are the key, bedrock to determining your ROC. So because Zara has, not done well, Zara has done well in these two, their ROC has stayed flat at 30%, while H&M's has fallen from 35% to just 10%, because the inventory turnover has not been good for a long period of time. And therefore, the answer is that, although Zara's market cap has gone up by almost 3 times, H&M's market cap is just 0.7 times of what it was 15 years ago. And this is how well Zara's done, but this is how H&M has struggled over these last 15 years. And also just coming to the new brands that have come in. So we spoke about Shein. Surprisingly, they've reached the same size of Zara in just 16 years. With $22 billion in revenues, and with inventory turnovers even better than what Zara does. And now even as a Lululemon brand from Canada, which was started in 2000, but just being in athleisure wear, they're doing almost $10 billion in revenues. So this is how new brands keep coming, competition keeps coming, and one needs to keep adapting and evolving. But Zara at least has cracked the fast fashion and has done really well. So now maybe we can have the answers of the poll and see how participants have answered in these two polls. So I see most people thought that H&M would have done a 4x return, but actually it's less than even 1x returns. It's just 0.7 times. It's a 30% loss. In fact, you would have gotten if you had invested in H&M for these last 15 years. And we can have the result of the second poll as well. Yes, so I think a lot of you have marked that it's 100% of Zara. So I think quite a knowledgeable audience that you all would have heard of this Shein brand. I think they're trying to come into India also with a tie-up with Reliance. So maybe most of you have heard of these brands. So yes, 100% of Zara is the right answer. Perfect. So with that, I think we are done with the first segment of our presentation. We'll jump into the second segment, which I think will be of interest to everyone, because this talks about the Indian retail landscape, where we have slides on each of the subsectors. So I think if all this is clear to you up till now, I think it'll be very easy for you to understand which Indian company in each segment is doing well. So jumping straight into this, and the first sector that we talk about is the grocery, and the grocery retail sector. So here, basically, we've said that discipline reigns supreme in this particular space. It's a large market. It's almost $700-800 billion by various estimates, but a very small percentage of it is organized today. And we've had only one successful player in such a large market. So even though we've seen the main reason for this happening is that if you see grocery as a business, so grocery as a business does only 15% gross margins. So if you compare that to other retailers do almost 40% gross margin. So that's a big difference. And after you exclude all the other costs that are required to run a normal retail shop, you are left with just 3% EBITDA margins. And this is in spite of doing 30,000 rupees revenue per square feet, which is almost 3 times of what other retailers do in apparel, footwear, etc. So at such a high revenue per square feet, you are doing just 3% EBITDA margins. And then and this is all at a store level. So when you start adding all your corporate overheads, etc., to make margins at a company level becomes extremely difficult. And that's why no company has really been, successful in this segment. But DMart has been the only, success story with a $35 billion market cap. And they're all their numbers, if you see over the last 5 years, have shown a 20% plus growth. So it's been a very successful business model at scale at almost 360 plus stores today. And the reason for this is that they don't have a lot of corporate overheads. They've decentralized the decision making at a store level. So all of it happens there. There are very few people who are sitting above those store levels taking all the calls. The store manager itself does it. So they have minimal corporate overheads. And also the model they follow is that they purchase a lot of their land of the stores. So 3% which goes into your rent for most of the players, that is not there for DMart. So your EBITDA margins already doubles from 3% to 6%. and then you follow all these other efficiencies, and also DMart follows the same scale economy shared model that we spoke about earlier, and they've done it at scale, and which has led them to being successful. So this is just how DMart has done well. DMart has launched DMart Ready, which is in the e-commerce segment. But however, there's a new threat that has come even to e-commerce, which is quick commerce. So earlier we used to have general trade, which was just these kirana stores, which are everywhere around our houses. Then you had modern trade, which is DMart and Big Bazaar and all these kind of players. And most of these other players like Big Bazaar and the Birla Mall, they've all shut down or struggled. Then it went to e-commerce, where you had Amazon coming in and Big Basket, etc. And now there's a new competitor called quick commerce, which is not there anywhere in the world but just in India. And it's surprising that how fast it's grown. So it's grown to almost $4 billion in size, which is actually quite close to what DMart's revenues also are today. So daily order values also they do of almost 17 lakh orders per day. And these quick commerce guys are, I think you all must have used them, like Blinkit, Swiggy, Instamart, Zepto, etc. So crazy how in such a short period of time some new segment has come in and done so well. So again, the need to continue to keep adapting and evolving. So I think with that we can have our next poll before we go on to the next slide. So this pertains to the current slide only. So with a $35 billion market cap today of DMart, what do you think is their share in grocery retail in India today? So feel free to pick the right option that you feel is correct. Yeah. And we can have the answers also for this. Yes, so I think most of you are right. The answer is less than 5%, but it's actually even less than 1%. It's just 0.8% of the entire grocery retail in India is today what DMart has been able to capture, which just shows the long growth runway they have, in spite of having a $35 billion market cap. So with that, we move to the next sub-segment, which is apparel. Here again, interesting that there are two different formats that can be followed. One is a retail format, one is a brand format. So typically, when you're a brand, you can only be a single line brand, because generally a brand will stand for something. So the examples of a brand, are ethnic wear. So you have Manyavar, which is Vedant Fashions company. Then you have innerwear, where you have the brand Jockey, which is part of Page Industries. Similarly, you have women's bottom wear, jeans. You have multiple categories, but a brand will stick to only one of these categories. But a retailer can do everything. They'll have private labels, which will have all these segments, under them. Also, a brand typically has they have multiple distribution channels. So they have own stores, they have franchisee stores, they go do through multiple brand outlets, they do through malls. Well, a retailer only does it through their own stores. So that's why they have a lot of more control on their inventory, and this is what helps retailers to grow faster than what brands do. So in India, Trend and VMart are the two retailers. So as you see over the last 5 years, the growth of Trend and VMart is far higher than most of the brand players, which have actually lagged the industry growth also of 12-13%. So it's important that you are able to use optionalities, increase your target market segment, and do various other things. And as a retailer, you can just have the flexibility to do so. If you're a brand, you would have to create another brand. You have to spend a lot on marketing, and it takes a long gestation period generally. In retail as well, if you break it down, there are two types. So one is the model is VMart follows, which is not fast fashion, but there's a fast fashion retail model as well, which is high revenue per square feet and high inventory turnover. So as you have discussed in our earlier slides as well, if you can manage these two, that's the fast fashion model, and you are able to achieve very high ROCs. And in India, only one company has attempted that as of now, which is Trend. They've done it. They did a joint venture with Zara in 2010, and they used fast fashion on West Side. Then they launched a cheaper version of fast fashion in Zudio, and it's done extremely well for them. And as you see, they have the highest revenue per square feet and the highest inventory turnover as well. And seeing the success of Zudio, now many new competitors have come into this space via Shoppers Stop, ABFI, Reliance, etc. So with that, we can have another poll as well. Yes, so I mentioned about how in India, the brands don't have too much of a leeway to grow. So how many brands in India do you think have crossed the INR 5,000 crore revenue mark today? We can have the answer also whenever everyone's done voting. Yes, so the answer is 5, but it's actually 0 is the right answer, because no Indian apparel brand today has crossed 5,000 crores of revenues. You have a Page Industries which is closer to that, etc. But still, no brand, either apparel also probably USP is the only brand with more than 2,000 crore revenue, but no other brand has been able to cross this particular segment threshold. So with that, I think now I'll hand it over to Dushyant, who will run you through the rest of the slides of this presentation. So thank you all for listening, and over to you, Dushyant.
Hello, good morning, everybody. Thanks, Kshitij. Thanks, Neha. I'd like to take you forward from here on out. And before we go into that, I think I want to ask another poll question. And Neha, if you can just bring that up on the screen about the profitability. I think this ties into what we've been discussing so far about inventory turns and about high revenue per square foot. So Tanishq as a brand has 50% higher inventory turns versus the rest of its peers. What do you think is its median ROE better by? How much do you think has that inventory turn really impacted its ROCs relative to its peers? So the three choices are in front of you, either 100, 200, or 300% better than the ROC that their competitors generate at a median level. And once we have enough questions, I'd like to move on to the next slide and then sort of go over the jewelry sector as well. Fantastic. So I'll reveal the answers at the end of my slide. So jewelry is a massive 5 trillion rupee market in India. Indians love jewels. And from the top left graph, you can see that despite a 10% appreciation in gold prices over the last 14 years, Indian jewelry industry has still grown at an 8% CAGR. What's shocking is how inelastic this demand for gold and jewelry in India really is. But a key takeaway from this divergent sort of jewelry industry growth and gold price growth is the fact that there is a negative 2% volume growth, because gold prices appreciated at 10%, whereas the industry is only grown by about 8%. So there's a negative 2% volume growth. And I think this begs the question, how did Tanishq as a brand and Titan as a company succeed over the last 2 decades almost? I think we believe that Tanishq came into the jewelry sector at a time when there was a massive trust deficit, and it was new to the market with a lot of innovative ways to attract customers' trust. Number one being the data brand that it was, and I was able to attract a lot of attention and trust within the name itself. Number two, installing hair meters at every Tanishq store helped them build more trust with customers by testing their jewelry and making sure that they knew what they were buying and what others had sold them as well. So that now has become sort of a commodity, right? The 3 largest pan-India jewelry players, which is Malabar, Tanishq, and Kalyan, all 3 of them follow a similar model where they all have keratometers. Even regional guys will have these keratometers. Smaller regional organized chains will have these meters to prove to their customers that what they're selling them is really what they're selling them. And I think as we look at how the country is also structured, the preference of gold jewelry across the country is extremely varied. The south of this country is a massive gold consumption center with 40% of overall jewelry industry accounting for that, which is reflected in the number of players who are organized within that space as well, at 33. Whereas somewhere in the north or west, which are the third and second highest consumption centers, the number of organized players within those spaces is significantly lower despite that. So there's a lot more competition today. A few tailwinds that will continue to sort of drive this forward is obviously number one is compulsory hallmarking, which was introduced in June 2021. And even though it hasn't been as drastic as it should have been, it has led to the formalization of a lot of the jewelry sector. Access to gold medal loans, again, makes it easier for them to manage their working capital and manage their inventory, along with GST, which helps regional players expand pan-India and establish presence across different parts of the country as well. The organized competition, on the other hand, for headwinds has gone up. I mean, you can see the number of organized players within South India as well. There are numerous organized players here in Pune, where we're based, that struggle, that will give tough competition to somebody like a Tanishq, Malabar, or even a Kalyan expanding in the lower markets. Lab-grown diamonds possess a massive disruptive power, which can drive down realizations very rapidly. And of course, consumer preferences evolving over time as younger generation comes into the gold buying age. Their outlook on gold as a financial savings product, the number of times that they make these purchases in their lifetimes, is all going to influence them. So there's a huge shift in the way people are consuming gold as well. Now, to bring this back to the discussion that Kshitij had earlier pointed out on how is retail structured and what are the two most important things, on the bottom right table, we have the 4 listed players here with their share of studded. So share of studded would include any jewelry which has precious gemstones inside of it. It could be diamonds, emeralds, rubies, and their inventory turn in front of it. So as the share of studded goes up, your revenue per square foot goes up alongside it, right? And that's what we're trying to show here, that as the share of studded for somebody like a Tanishq is at 33%, along with high inventory turn and managing their working capital better, they generate a 51% ROC at the store level. And for example, somebody like a Kalyan, despite a higher share of studded at almost 30%, has significantly lower inventory turns, which drops down their overall ROC profile. And a Senko and Tanga Mile are the opposite case, where both of them do a similar share of studded, but because of higher inventory turns with Tanga Mile jewelry, they generate a significantly higher ROC. And so this again ties into what we were talking about earlier, that the revenue per square foot and working capital management are the two most important pillars of establishing a strong retail network. I think this is also a great time to show the results of the poll, where we discussed what the ROC profile people think is. So if we can just pull up those answers. Neha, do you have those answers from the poll? There we go. So yeah, so the median for the other 3 guys is about 16, which is a fundamental number, and Tanishq generates 51%. So the answer is actually 300% better than their competitors. That is the power of sort of high inventory turn and high revenue per square foot that it can have on your overall ROC profile. Next, we'd like to jump into the footwear segment. Footwear is a largely unorganized space. And this is something that has attracted a lot of attention from the listing of a few key players in the last few years. And despite being as large as they are and as prevalent as we see them in our daily lives, top 15 organized brands only account for about 23% of the overall pie. And if you include the entire organized pie, that's roughly about 35% of the overall market. And despite being in such a minority in this space, their revenue growth has lagged the industry growth. So for example, on the right-hand side here, we have how the difference in mass segment growth, which is items up to 500 rupees, have grown relative to Relaxo, who's largely a mass market brand. So Relaxo, while has grown at 5%, the industry's expanded at 6%, right? And similarly for economy sector, which is 500 rupee to 1200 rupee products, the market has expanded at 9%, whereas Bata, who's primarily in this space, has only expanded its revenues by about 3%. So again, ceding market share to either other organized guys or a large unorganized market here as well. Campus being the outlier with leading its industry growth, mostly because it's starting from a lower base, and sneakers as a category is also a much smaller category, but it's delivered a 19% CAGR relative to a 14% for the overall industry. Mid-premium, which is above 1200 rupee, is growing at 12%, whereas Metro, with its wide offerings and multiple store locations, X of Crocs, because again, that's an organic acquisition, has only grown at 11%. So across the board, except for Campus, everybody has seized market share despite being heavily in an unorganized space. And because of ceding this market share, they've had to focus on inorganic tie-ups. Metro has acquired brands like FitFlops, Crocs, and Fila, and most recently they acquired Foot Locker to bring it into multi-brand outlets. Bata has acquired Hush Puppies, Nine West, and Disney brands to be able to expand the space for themselves as well. Excuse me one second, I think we lost. Yeah. Great. Perfect. Sorry about that. Right, so just to bring it back to what we were discussing earlier about retail being a high revenue per square foot and high inventory turnover space, there are two models that companies choose to follow in this route. There's either you generate extremely high margins or you generate really high inventory turns. So for somebody like a Metro has focused on that margin side of things, which leads them to a 30% EBITDA level margins, which helps them generate a long-term 25% ROC profile. Whereas somebody like Relaxo has focused on a lower margin but a high inventory turn space, which gets them still above a 20% long-term ROCs. So while both of these generate high ROCs above 20%, their approach to the problem is extremely different. Where Metro focuses on the mid-premium, higher margin profile products, whereas these guys will focus on Campus and Relaxo will focus on higher inventory turns. So before we move on to the next slide, I wanted to throw up one more poll question, and if Neha can just bring that up. Okay, so Zomato, I mean, we've all used Zomato. I think I've used it at least once a week for the last 2 years, but since October 2022, when there were about 200,000, 2 lakh restaurants listed on Zomato, what do you think that number has grown to today? So in about 18 months, has that number expanded from 2 lakhs to 3 lakhs to 5 lakhs, or has it shrunk to about 1 lakh restaurants? And we'll just wait for everybody to fill in their answers here, and then we can move on to the next slide. Hopefully this also gives you a little flavor of what that next slide is going to be discussing. Great, so I think enough answers are in. Let's move on to the next one. So next we want to discuss the QSR space. Now there are some brands here that are instantly recognizable to a lot of us. This is a space that has evolved massively over the last decade. And if you think back to 2013 or 14, when this initial brand proliferation started to happen, as a category, pizzas and burgers were the two large, and most of us would relate to this, the two only categories for QSR dining. Right? McDonald's, KFC, Burger King, and Domino's, and Pizza Hut were the brands that we all knew and loved. And from 2013 to 17, when there was a high inflationary period, but no food delivery apps, their median SSSG languished at about 2% for that time frame. But then come 2018, when there was an explosion of food delivery apps through Zomato, Swiggy, and then Foodpanda, I think there was Uber Eats, and lots of regional players within Bangalore, Delhi, and everywhere. These guys, because of their brand image, were able to capitalize on easier access and discoverability across a wider range to deliver a median 10% SSSG over the course of those 2 years. Now, setting aside the COVID years, because those led to significantly lower and then suddenly higher SSSGs, moving on to today, there are multiple categories for customers to choose from. Right? Customers can choose from either categories of pizza, burgers, and now sushis, Lebanese, Mexican, Israeli food, and God knows Thai food, how many each of us see on an everyday basis. But also within each category, the number of brands has also exploded. Right? For just pizza alone, there's national chains like 1441 Pizzeria, Lapino's Pizza, Mojo Pizza, and Vanessa, and whatnots. Right? So it's not that there's not enough, there's too many options now for customers to explore. Right? So which is why the SSSG for these guys, despite such a massive audience existing still has only been at 3%. So it's significantly dropped from that 10% we're used to seeing because of this heightened competition that has been enabled in a large part because of these food delivery apps, which used to be a massive boom for them, but now they're acting as a bane. And just as a side note, the number of brands on Zomato in the last 18 months has grown 50%. There are now 3 lakh restaurants listed on Zomato alone, which can deliver food to you. So the options available to you are innumerable. And now jumping back into the retail theme, right? High inventory turns at lower, higher revenue per square foot. Pizza as a category inherently is a low capex business. And that is reflected here when you compare Domino's and Pizza Hut versus a McDonald's and a KFC, where the capex per store for Domino's and Pizza Hut is significantly lower than what it is for McDonald's because of how Jubilant has invested in making sure that costs are at the forefront of controls. They have been able to generate a higher EBITDA margin at a gross margin level and as well as an EBITDA margin level, which has led them to significantly expand their ROCs beyond what most of their competitors have been able to do. So at 30%, nearly 30% store level ROCE, Domino's is far superior in terms of cost control, in terms of inventory turns, and in terms of revenue per square foot relative to Pizza Hut or KFC or McDonald's here. I think now is also a good time to sort of jump into our answers for the poll, because the answer was about 3 lakh restaurants. Let's see what most people think. Yeah, so I think a lot of people thought that it was much higher than that. And yeah, it is 3 lakh restaurants and 50% growth in about 18 months is huge. But yeah, this 5 lakh number is not too far away as these brands, as these food delivery apps expand beyond their markets and they continue to grow at high double-digit growths. Next, we'd like to jump into the third part of our series, and I think we want to talk about the valuation front, about what is going on with the valuations in this sector. Retail is one of the sectors with the highest valuation multiple across all, and as you can see here, footwear trades at a trailing multiple median of 90, and somebody like grocery, which unfortunately only is DMart right now, but trades at 112 times trailing. And even if you look at FY26 multiples, they're still significantly higher. And we wanted to go through why we believe that is. Why is it that these companies trade at these seemingly exorbitant valuations, and how are they justified? The first and foremost is the large opportunity size. I mean, India is a very, very heterogeneous consumption market where you can split that pyramid into 3 core sections, where the top section, which is about 120 million people across 30 million households, which have a spending capacity of $15,000 per person, right? Those are the people who look for not only convenience, but they also look for catalog, for a wider variety. How convenient is it for them to shop with you? The next part of that pyramid, with 300 million people and 70 million households, has a spending capacity of about $3,000 per person. And those are people who sort of try to balance between catalog and cost, wider variety at the right cost for them. And then there's the 205 million households and 1 billion people, which at $1,000 per person are only competing for cost. So when you look at the consumption pattern there, it's driven extremely and only by cost controls over there. And if you look at the grocery market in India, jewelry, apparel, footwear, and QSR, they make up about, grocery makes up about 77% of the Indian retail market, right? And relative to, we have US and China here to showcase how much larger the Indian retail market really is for grocery relative to those in more developed economies. And when you look at jewelry, it's double of what it is in US and China, whereas something like an apparel and QSR falls significantly smaller. So what we're trying to show here is the large opportunity size available for how much these companies and brands can expand into. And QSR, despite being 100% organized, and only makes about 1% of the total retail market in India, relative to even China, which is at 7%. So massive headroom for growth, massive runway for growth. The other thing that we want to stress upon is predictability of earnings. And so in this chart, what we've tried to show is using the assumptions listed at the bottom. What is the trailing multiple that people are ready to give according to a DCF? If you have the visibility of the next 15 years of sustained growth, at 15% growth for the next 15 years, what kind of a multiple would you be willing to give to a company today? Similarly, as you go up the curve. So the predictability, because of the large opportunity size and the varied consumption pyramids within India, gives it a large runway for growth. Now, at 1%, QSR has a massive runway for growth to expand into the retail market, to expand offerings, to expand across different places as well. So to tie this all in together, I think we want to focus on what we've been talking about from the first section, which is high revenue per square foot and high inventory turn leads to high ROC, which the market absolutely rewards. So here, what we've done is we've just taken 5-year revenue and PAT CAGR for the companies that we've discussed, compared them with the inventory change over the last same time period in absolute terms, and the latest ROC they generate. And then we've tried to see which companies have performed the best and have they met the parameters that we are discussing. So the ones that have a star next to them are not 5 years old. So somebody like a DMart and a Trent are the ones that stood out the most to us. And DMart has grown its revenue CAGR at 20%, but the CAC has grown faster than that, which means it's been able to gain some scale efficiencies. And that has led to inventory turns changing by 5% over a 5-year period. With a 20% sustained ROC, they've delivered a 20% market cap CAGR over the same time. And the same thing for Trent, at 36% revenue growth, but 73% PAT growth over a 5-year period. Its inventory turns have changed by 47%, which has led to an increase of 75% in its market cap value. So despite at the start of that 2019 cycle still being considered quote unquote expensive companies, if there is high visibility, the markets continue to reward them. The markets continue to reward sustained and predictable earning over a long period. And to stress again, the two most important factors within that are revenue per square foot, which is reflected by the change in revenue, CAGR and PAT CAGR, and the working capital management, which is reflected in inventory terms. So with that, I think we would like to end our slides, and I think we can take on questions.
Great. Thank you so much, Dushyant and Kshitij, for that very detailed presentation. We definitely have a lot of questions which people had sent to us via email or during registration, as well as we'll also be taking multiple live questions. So request all participants to post in any live questions which they want to, and we'll ensure that all of them are addressed. So starting with some of the questions that we already have received. Okay, a very interesting one actually. So if someone had to choose between all the 5 segments in retail which we just discussed, then which one would both of you think is the best?
Sure, yeah, I can take that one. So I think it's very difficult to actually choose between these 5. What we are actually trying to say is that even at SageOne, we follow companies where we follow the earnings growth, and we also do bottoms up stock picking. So typically it's not something where we want to actually tie in and say that this segment is the best or the worst. I think in each segment there are different winners and losers. So of course we need to point out which ones they are, and I hope through all the slides we've been able to at least tell you all that what are the key drivers for each one of them. So of course in grocery we have only one listed player, but in apparel we've been able to show that who's done the best. In QSR, I think Dushyant spoke about who's done the best, etc. So in each segment there'll be different winners, but going forward, if we had to pick one, that would be difficult. But it would be a bottoms up stock picking where the company which is likely to do the highest revenue per square feet growth and improve the inventory turnovers whilst keeping all the other checks and balances in place are expected to do the best. And also, we can focus on companies where they follow the scale economy shared model, because these, companies that have done that for multiple years, keeping the cost low, are the ones that have been able to, generate a lot of returns over long periods of time. So endeavor would be to focus on such kind of companies rather than to, actually focus on which segment is the best. It's to do a bottoms up stock picking. and then identify the right one where these factors all fit in.
Sure. And any particular source of material that you recommend to everyone to learn more about these sectors? Because I'm sure both of you would have referred to a lot of them.
Yeah, so when we initially ideated this, there's a podcast series that I've been listening to for a little while. It's called Acquired Podcast. And these guys are long form podcasters where they'll spend a month or 2 months, sometimes longer, researching a singular company and then doing a 4-hour series explaining the ideation, the birth, and the evolution of the company throughout its time. So we listened to, I think, a couple on Costco, some on Walmart, some on Warren Buffett style of investing, some on luxury brands, and across the board through Nike's, Footwear, everything, to sort of get to an idea of how these brands that have been successful in history, how have they maintained their prowess? How have they maintained attracting customers across different cycles, across multiple decades? And what is it that really separates them from the ones that have failed? So Acquired Podcast is something that we highly recommend. Kshitij mentioned Nick's sleep at the start of this discussion, and I think his memos, a little dense, but absolute treasure troves. They helped us sort of ideate this scale economy shared model into the simple words that we shared with you today. But those are absolutely invaluable in helping us understand how the retail space is structured. A book that we both have been discussing is also Store Wars, and they also talk about the shared scale economies model. And we think that these are some of the best sort of ways to learn about the retail space. And of course, understanding it from reading about these companies, understanding it from talking to them, and from linking what we read in these sources like Acquired Podcast, Store Wars, or Nick's Leak memos, and then trying to find the parallels between this and how the company's discussions go. I think those have been super helpful. So highly recommend all three of those to everyone.
Oh, excellent. And I think I'd just like to add to it, perhaps a lot of the channel checks and on-ground research that you guys have done to actually conclude on a lot of what you have read has also been very meaningful in this entire exercise, right?
Absolutely, yeah.
Great. So, and how about, we have spoken about all of these segments and what are the factors to look into. But if I have to sum it up into, say, a couple of factors which could lead to creation of long-term moat in retail, despite a lot of continuous tech disruptions which we see all around us, and you did talk about quick commerce and a lot of tech-related commerce platforms now, which have already disrupted a lot of these industries, but yet you continue to see some of these players long-standing and continuing to grow. So any key factors which you think could be the right recipe to create long-term moat, which you'd like to just highlight?
Yeah, sure. So I think Costco would be a great example to bring up here. That in spite of e-commerce coming in, they just decide to stick to what they are doing, and today also they continue to grow at a similar pace with very high ROCs of 27%. Someone like a Primark as well. They've done well in the UK, but they also when the whole COVID period happened and a lot of people actually went on to selling on e-commerce. They actually didn't do that. Their stores were shut, no customers are coming, but they said we'll just stick to what we know doing best, and they didn't pivot to e-commerce. So I mean, while it's important to also know what the trends are, but if you've created your own special niche, and which is by again, as we highlighted through the scale economy share model and the revenue per square feet, inventory turnover. So if you get these few 2-3 things right, and you're extremely efficient, even when you scale at when you grow at a big scale. I think these are key. Most companies, I think, when they try to scale up, they find it very difficult to manage all these things. So it's very important that when you're a small player, you have the right checks and balances, you have the right systems in place, you decentralize, you adopt technology from so even like a Costco, they use a lot of technology, although they're not an e-commerce player. But they do a lot of data mining to know that which are those 4,000 stock keeping units that should be there in their stores. So it's very important to know exactly what are the tools that you need to use and what you need to scale up. They may be different for different players. And as you see, Dushyant also pointed out, the industry is huge. Like grocery in India is huge. The whole retail market in India is huge, and US is huge. So I think there's a place for everybody. Even in grocery, we've seen even the local kirana guys are still there. Although they may not be doing as well as they're doing earlier, but they're still around. So it's all about you creating your own special niche, your own special mode, And once you bring down your costs and pass it on, you create such a mode that if any new player wants to enter today, they'll have a long learning curve, and also they would need to reach that scale in order to compete with you. So if you are able to achieve that, then that moat is likely to sustain for a long period of time. So once, even a few Indian companies which have managed to achieve that moat and that scale, it's going to be very hard for new entrants to, break them going forward. So this is how, we see the entire landscape.
Excellent. And I remember you also mentioned, I think, Kshitij, during the conversation pertaining to the grocery segment, that less than 5% is organized even today, right? With DMart being, I think, less than 1% of the market.
1%, yeah.
So you think there is, with that context in mind, there is scope for newer players to establish that long-term moat and make a place for themselves, despite these few players already being there in India and having established that place. It's not probably about competition, but coexistence scope is there.
Yeah, sure. So there is a coexistence scope. So as we've seen already multiple players being there. Like Bazaar was there, Aditya Birla Mall is still there today also, but they're shutting down stores. The problem is, I think, not of the opportunity side. I think that remains huge. It's just about actually driving your business efficiently when you keep growing. So I think that has been the challenge which many players have not been able to, really capture. So Reliance also obviously is a very important player in this, but data in Reliance is scarce. So therefore, we don't particularly have a view on how they've done, because they do a lot of things in their entire retail basket. So whether grocery for them is doing well or no is we don't know that as of now, because you don't have enough data that the company shares. But overall, yeah, there's a big opportunity. I think a lot of players can coexist, but if they can figure out the right model, and I think quick commerce has entered well in this space. They found a niche which is again very different, and they've reached DMart size in what 2, 3, 4 years. Such a short period of time. So definitely, I think in all the sectors, whether it's apparel, footwear, grocery, QSR, jewelry, there's massive scope for multiple players to be there, but it's all about them getting the business model right.
I think just to add to Kshitij, right? If there's two pillars that we've propagated throughout this, both of those are vital. You can't do one and not the other, especially in a space like grocery where you're operating on razor thin margin, and as soon as you add corporate overheads, the whole house falls apart. So you have to do all of the things right. You can't pick and choose. So it's very important to make sure that you are disciplined throughout this process. I think that's where the real key lies. That's what will separate that. Not that there's going to be a problem with multiple players existing in the same space, but the fact that a lot of them will not be disciplined enough to be able to do that over a 20, 25-year period.
Great, understood, absolutely. Another question that I had was pertaining to a lot of these e-commerce companies coming up, especially Amazon and Flipkart, and the kind of innovations that they're bringing on the table. Like, for example, you now have same-day delivery, right? And I think it's available with Amazon and Flipkart both, right? And this is not just focused on one segment, but multiple segments. And so how do you think the traditional retailers will survive when these guys are spoiling customers to that extent?
Yeah, I think we touched upon this in the Walmart Costco slide as well, where we discuss the impact and actually the kind of growth that somebody like an Amazon has seen, and how much e-commerce has really penetrated our daily lives, right? Over a course of just 20 years, it is 22, 23% of the overall retail spends across the globe, and this is across the globe where there are countries where it would be single digits most likely. So if it's at 22% across the globe, you can already imagine the kind of disruption they've brought to the fore. And despite all of that, Costco continues to expand, and the charts we have there show that, right? Over the last 20 years, the way Costco has also grown, continues to expand. So it's about offering a distinctive value proposition to your customer, sustaining that, and continuing to be disciplined about the way you operate those businesses, I think is what's key. Of course, there's going to be disruptions through e-commerce, through quick commerce now, through ways of delivery, through channels of buying, but at the end of the day, each of them offers a distinct value proposition to its customers. And India being the heterogeneous market that it is, there is a massive space for everybody to operate within this, right? So there's that pyramid that we've shown earlier that points this out in perfect beauty and encapsulate the kind of market space that's available across the board for most of these guys.
Sure.
And just to add the same day delivery, so it is challenging, because when you reject a product and it gets sent back, so there's a lot of cost that these guys need to incur. But I think a few players have found a way to get around it. So like a Zara, when you return a product, charges you 100 rupees on that product. Somebody like a Trend, they give you an initial discount if you agree that if the product is not suitable based on size or is some defect, then you personally have to go back to the store and return it yourself, and that's why they give that discount. So I think companies are trying to figure out how to get around these logistical challenges. So even offline brick and mortar guys who are not present, say predominantly in e-commerce, they are finding out how to adapt and how to make it easier for a customer to get whatever they want whilst maintaining their profitability.
I think in case in point for that is somebody like a DMart Ready, which you can place your order online and go pick up in store. So it's trying to find ways to work around that and innovate across. Key remains offering that distinct value proposition for your customer.
Yeah, absolutely. In fact, you guys just covered one of the questions that I got, which was pertaining to, whether self pickup will succeed or not to solve the shipping, especially the returns challenge, right? But as you rightly said, all of these guys are working around it. And good thing that they're doing is being transparent about the cost aspect of it by highlighting that, if you're shipping, that you have to pay for it.
Right.
Absolutely. Amongst the wars of the entire offline retail versus tech that we keep talking about all the time, and we keep talking about how each one is getting into the other. Now that we have established that there is definitely room for both to coexist because the market is really large and there's audience for both in a substantial manner. Do you think the kiranas, the traditional kirana stores which used to be there and dominate the entire ecosystem at one point, are they somewhere finishing, or is the time up for them?
I think finishing in time up is a little strong word for them. I mean, quick commerce, the way that it's proliferated across urban markets, is still very much an urban phenomenon. And I mean, if you go through Blinkit's last filing, you can see the kind of concentration that it's been within the top 2, 3, 4 cities. So it's hard to exactly call that out. And as they sort of also figure out their own business models, the right product offerings for their customers. Now there are reports of Blinkit offering PlayStation 5s and iPhones on day of launches. I mean, of course, a little gimmicky, but yeah, there is definitely some learning room here. And I think what we were discussing earlier, where some of these brands are trying to figure out ways to improve, I think Kirana stores will also trying to figure out ways to improve and offer that distinct value proposition, right? So while Zepto exploded, I know anecdotally the store that I used to buy my stuff from said, you just give us a call, we'll send it over. There's no need to come into the store, which is not a service they had earlier. So I think they're also figuring out, I think this will be a continuous learning process. Where it'll settle, I'm not sure, but I think it's too premature to say Kiranas are going to die in this sort of a space.
Sure. And one question which I had was more broad-based on consumption side. While a lot of these phenomena and a lot of these examples are still concentrated on tier 1, tier 2, but then we did speak about kiranas, and we also know India at a country level, consumption, when we say quote unquote, is driven by rural consumption. So any suggestions or any key indicators that you look for, any lead indicators to understand when there will be surge in rural consumption, and the sectors or the subsectors amongst what we discussed, which could actually get impacted by it?
Sure, yeah. So I think rural consumption has seen a bit of a trough over the last few years, because I think in India we've spoken about this K-shaped recovery, where I think more of the premium side has done well, and the rural side has really kind of lagged. But however, I mean, the rural side will be dependent. Like monsoons is a factor where it is dependent. Also, inflation was high, but now it has started to at least stabilize to a certain extent. And I think a lot of these rural wage workers also they left their jobs, went back to the villages, took a little time to get back. But I think now they started earning again, and they went through a very lean period of 1 to 2 years with very less savings, etc. But I think these things are reversing. So how we like to see this date is through data only. So we've seen V-Mart, which is more of a rural-oriented player because they mainly focus on tier 3 or 4 towns. They that SSG was very subdued for a lot of quarters, but this is the first quarter where they've seen some kind of an improvement. FMCG companies I think talk about volume growth, and I think some of them are talking about volume growth finally improving, at least from the lows that it was present in. So, I mean, see, it's still going to be wait and watch because it's only one quarter of data, which seems to suggest that rural is, coming back. How the monsoons pan out will also be important to see, what happens over the next 2-3 quarters. So, I think we'll keep analyzing this, but definitely, few sectors will get benefited. There's something like a Relaxo, which is, say, present only in the mass segment, under 500 rupees. They may do well, when rural comes back, etc. So, some pockets like again V-Mart, etc., which again focuses on the tier 3-4 towns, they may do well. So companies predominantly present in those regions can do well, but we would wait for some more quarters of data to come in before forming a judgment on this.
And just to add, as a list of sort of lead indicators that help us determine if there's a trigger, Manrega enrollees, the number of people looking for employment through that is a fantastic source to see where that economy is headed, where that part of the consumption pyramid is headed, and how that's doing. So that's another thing that we very closely monitor.
Sure, that's very helpful. One question which I got was pertaining to the quick commerce businesses. Do you see a path to profitability for them? Is there any timeline which these guys have announced or they have in mind? And do you see that to be feasible?
Sure. Yeah. So I think at least Zomato through Blinkit has shown that they had become at least come close to profitability last year. But the issue is that a lot of players are now jumping in. So you have Reliance, which is saying that they want to do it. Your Flipkart, your Amazon. Everybody's setting up these so-called dark stores, which are like your warehouse or something, which you need to service your customers. So, with the competition increasing, even Zepto, which is another quick commerce player, they got a big funding recently. So, how this space will evolve is going to be, something we need to watch out for. But one thing I would like to say is that, for Flipkart, Amazon, Reliance, and all these guys who've been so used to, delivering over a 2-day, 3-day period, it's going to be very difficult for them to, change their entire business model, way of working, and come down to, delivering things in 15-20 minutes. I think you need to be extremely nimble. Would use tech a lot. I think even Blinkit would have data of almost 4-5 years now, where they would be knowing that in which particular segment what is selling. So say in one particular locality, what is the most selling thing, and they would only stock that inventory. So I think they have a big head start. They put all the tech in place. For anybody else to do it would take time to understand and adapt. But having said that, because competition may go up, maybe players introduce more discounting. Maybe you have more options, than what you had earlier. So competition will go up. The profitability is unclear. Even the opportunity size, right now we are all banking on it being present in maybe the top 8, 10, 15 cities, maybe. If it has a use case in more cities, then maybe there is again a place for every company to be present, in this space. Also, how much of local kirana's market share are they taking away? That's also another thing. How many customers are willing to shift? So I think a lot of dynamics at play. It's very nascent, very difficult to form a judgment as to what will happen. But definitely the three players that are currently there, say Zepto, Instamart, and Blinkit, they have a head start. And to break for some new player to come in, I think that's going to be more challenging. But between three of them, the competition may be high for the next few years.
Right.
Sure. And during this answer, you did mention that what if they expand beyond the top 10, 15 cities where they are present today, and the entire scope only expands, right? In terms of the market that they can cover. But you think the cost of fulfillment as you go down the curve in terms of cities would really help aid in meeting the profitability, or would actually probably reduce their chances of getting to profitability?
I think this is a much more in-depth sort of question that goes specifically into quick commerce, right? But this is something Kshitij and I, we've been doing a lot of discussions over the last few months, trying to figure out what is really that addressable market size, right? Like, in an attempt to gain customers, there was a lot of cities that initially food delivery apps also expanded into, but they very quickly realized which customer is worth acquiring and which ones aren't. So I think most of these quick commerce guys are going through a similar learning where they're still trying to figure out at what price point is that convenience going to overpower whatever you charge that customer. So I think it's something to keep a keen eye on. Expansion beyond top 8, 10, 15 cities, I think will be a very important monitorable. And I think because of only one of them, which is Blinkit, being listed under Zomato, I think the lack of sort of competitive landscape is going to be a little challenging to decipher this. Let's hope more sort of disclosures come through from them. But I think as we figure out where that profitability in the top 8 versus next 8 cities lies and how those consumptions change over the life of that dark store, I think it'll be key to keep track of those things. So yeah, work in progress, I think.
And just to add, again, even the dark stores follow the same concept of retail, so revenue per square feet. So if you see, the pyramid that Dushyant had showed earlier, the currently only and the top part of the pyramid is what uses quick commerce, but the second and the third part would not be using it at all. But if say the first pyramid only, first part of the pyramid tends to increase, and say more and more people in India, earn more money, and they tend to take that step up because of all the various tailwinds like urbanization, etc. Then it's possible that that opportunity size may expand by itself. But as he rightly said today, I mean, it's still a wait and watch, very nascent market to talk about.
Fantastic. I think it has been a very, very interactive and very good session. I really learned a lot about all of these aspects of retail. Thank you so much, guys. This was the last question. Anything from your side? Any closing remarks, please?
No, I think what Chilton and I would just, when we were discussing this, the idea was to give people the two things that are static, to give you a toolkit wherein you can separate out all of the noise and just focus on the most important aspects within this space. And I hope that we've been able to convey that to everybody here, that these are the two most important things that you need to focus on, and everything else falls into place. It all has to lead to this. And so I think that's really it for me.
Yeah, no, absolutely. I mean, we just hope that, we try to keep it very simple, very crisp, and give you a flavor of the international markets, the Indian markets, and what all is important. So if you have any further questions also, or any, anything that you want to know, please feel free to write to us.
Yes.
And we would love to do more of these sessions also, in the future, so that we keep sharing our knowledge with you. So thank you everyone for your time. Thank you, Neha.
Thanks.
Thank you so much, both of you. With this, we'll conclude the second episode of SageOne Manthan Series 2. Have a good day, everyone.
Thank you.